This is episode 122, Cap Rates. This is a 39.6 Facebook and YouTube Live daily finance show, the show that teaches high earners like yourselves how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, syndications, Airbnb, paying for college, paying for childcare, and even the car you drive. We continue our series on multifamily finance, cap rates. All right. If you can see me, you can hear me, please let me know. I'm going to share my screen here. Restream often does not want to show my screen the way I want it to be shown. So if you can see it, please let me know in the chat box if you can see my full Excel spreadsheet here. Okay. I'm using the same spreadsheet that I was using yesterday in episode 121. Okay, I made a few adjustments to this to focus on cap rates. So first of all, cap rate means capitalization rate. Okay. It has a very simple equation. NOI, net operating income, divided by the price or value. Okay. You can also rearrange this equation. Price equals the net operating income over the cap rate. Now, it's important to know that cap rate, when we're talking about commercial real estate, multifamily properties, cap rate is not something that you are in control of directly with your asset. If you increase the value of your asset by increasing rent or decreasing expenses, you do not change the cap rate. You may increase the value, but you're not changing the cap rate. This is in distinction from single family properties, where if you increase the rent, sure, you may be changing the cap rate on the property, because single family properties are not really valued based on how profitable it is. It's valued based on what somebody would pay for it. So we're going to avoid single family. We're going to focus here on commercial multifamily investing. So cap rate is a market rate. Now, when we take our example from yesterday, we're purchasing a property at $1.5 million. Okay, this is the first set of columns here, column C and D. It earns $110,000 in rental income, $10,000 in other income, for a total revenue of $120,000. We went through all the expenses yesterday, but the total operating expenses are $55,000 per year. You simply subtract the total operating expenses from the total revenue, and you get the net operating income. 120,000 minus 55,000 equals $65,000. Now, if you take that $65,000 and divide it by the purchase price of $1.5 million, that gives you the cap rate of 4.33%. So for example, somebody could be selling this property and they can show you on their trailing 12 months of income and expenses that the net operating income over the past year was $65,000. The market cap rate for purchases could be 4.33%. And you would simply take that $65,000, divide it by 4.33%, and that would give you the price of $1.5 million. Okay. Now let's pretend you were, so the selling price of this property here is $1.5 million. Let's pretend you held on to the asset for a number of years and the market rate is exactly the same, 4.33%, the market cap rate. And then you sell it. Well, the total revenue and total expenses, all of that is exactly the same. So the selling price will still be $1.5 million. You will have made zero profit. And in fact, you would lose money because there's a lot of transactional costs of selling a real estate asset. So this first scenario I'm taking here as no change in the cap rate when you buy it and when you sell it. And there's no change in your operating income, your net operating income. Now, in a market where, let's pretend there are new properties being built that are similar class properties to yours, like you have, let's say, a Class A property and they're building more Class A properties, Well, now there's more supply. And if there's more supply, then the price goes down. So that's assuming that the demand is exactly the same, like there's the same number of people. An alternative situation is you're in a city in the Midwest that is losing jobs and the total population is going down. And so there's less demand for a property. And therefore, the price also can go down. Those are market prices. In this situation, let's pretend you sold it, and at that time, the market cap rates are higher. Okay, so it goes up from 4.33% up to 4.83%. That's a 0.5% or a 50 basis point increase. If you are holding on to an asset for 5 years, is very reasonable, and some would say conservative, to add 0.1% or 10 basis points every year that you hold on to the asset. You cannot assume cap rates are going to stay the same while you hold on to the asset. Market prices change. They often go up, they often go down. They could stay exactly the same, but you should not count on that. Okay, again, you don't have control over market prices unless you own like all the properties in the area. So the cap rate goes up to 4.83. In this example, your operating income, the revenue minus expenses, has not changed, only the cap rate. So what is the property now worth if you were to sell it? Well, you would take that $65,000, you would divide it by 4.83%, and that would be equal to $1.34 million. Unfortunately, that is now less than what you purchased it for, which was $1.5 million. You actually have now lost money of $155,000 in addition to your transactional costs. So this is something that you need to be very cognizant of when you're holding on to a commercial real estate asset. The market cap rates you don't have control of, and they could go up, which could cause you to lose value if your net operating income does not change. Okay. Now, on the other hand, let's pretend you own a property in a place where either the supply is going down or the demand is going up, or both. It's hard to really expect supply to go down because properties tend to last a long time, but it is not unreasonable for the demand to go up. If you are in a city where there is substantial population growth due to job growth, due to an environment that is friendly for companies to move there, like in the Texas Triangle, for example, a lot of companies are leaving California and moving to Texas. Well, that demand for housing props up the value of housing, especially when you have assets that cannot be replaced. So let's pretend you were to buy a Class B asset. It's very expensive to build new construction. If you're going to build new construction, you're going to build Class A because the profit's not really there to build something that's lower class, at least not right now, because labor and supplies are very expensive. So you're going to build expensive properties that make more revenue. Okay, so Class B properties tend to be a little bit more protected. Now, that is changing as prices keep going up. The cost to build may approach the cost to buy, but at the moment, in a lot of places, it is not yet there. So if the population keeps growing and you can't increase your supply, then the demand should go up. So the cap rates could go down. In this example, 4.33%, the cap rate goes down by 0.5%. For example, over a course of 5 years, it could go down by 10 basis points or 0.1% per year. You go down by 0.5%, and now you're at 3.83. You have done nothing to the operating income. It has stayed the same. It's still $65,000. Well, $65,000 divided by 3.83% is actually now $1.7 million. So you've actually, just by holding on to this property, it has gone up by $200,000 in value based on a 0.5% cap rate decline. Okay, so when cap rates go down, that's like market appreciation. And when cap rates go up, that's market decline in price. Now, these are assuming that no changes are done to the operating income. But let's pretend you are to increase the revenue. Let's say we're going to increase other income from 10,000 to 15,000 over the course of 5 years. We're going to make people pay for valet trash. We're going to make people pay for parking, covered parking, storage units. We could be putting money in as capital expenditures to build things that they will pay extra rent for. We can charge pet rent, things like that. And we drive this up to 15,000. So now our income has gone up by $5,000. And let's pretend we are able to decrease some of our expenses. Let's pretend we are able to decrease some of our, let's say, payroll costs. Let's take this down to $10,000. And let's take down our property management. Well, no, let's not do that because our rents are going up. But let's pretend we can decrease some of our turnover costs somehow, and we go down to 3,000. And let's say we build back utilities to the tenants. Okay, so let's actually bring this down to $1,000. Okay, so now we've actually decreased our expenses by $10,000, I think, and we've increased our income by $5,000. So now our net operating income has gone up from what used to be 65,000. Now it is 80,000, 125,000 minus $45,000. Now remember, the cap rates don't change when you increase your operating income. Those are market based. So if we use our new value of $80,000 over 4.33%, ignore this box right here because that was the original price. But 80,000 divided by 4.33% is now $1.846 million. So you've actually increased the value of the property by $346,000 by increasing your operating income by $15,000. Because that $15,000 gets divided by 4.33%. That's basically like dividing it by somewhere between 20 and 25, maybe around 23. Okay, that increases the value by $346,000 because of 4.33%. If you do 1 over 4.33, that's 1 divided by 4.33%. That's going to be about 23 or so. So it's a multiplier of about $23 of value increase for every $1 that you've improved your net operating income. Now, let's pretend you do this over a 5-year period of time, and the cap rates also go up by 0.5%. Well, even though the market has softened a bit, because you've improved the operating income from 65,000 up to 80,000, you have still increased the value of the asset by a total of $155,000. You really increased it by $346,000, but because the property had gone down by $200,000 due to market change, you're still in the green. Okay. Now, in an ideal situation, you're having a decrease in cap rates, but also increase in net operating income. So you get a double bonus here. Okay, so now at a cap rate of 3.83, that's less than 4%. So every dollar you improve your net operating income, 1 divided by 4% is 25. So every $1 of net operating income, you're actually increasing the value by $25, or actually a little bit more here. So by improving your net operating income by $15,000, and because the cap rates have gone down from 4.33 to 3.83, you've generated almost $600,000 of increased value. Now, this property was a $1.5 million property. You may have only spent $300,000 acquiring it with a 20% down payment. Well, you still get the full $600,000 profit approximately here. So you could like triple your money. Okay, so this is the way cap rates work. They focus on strictly the net operating income, okay, and the market price in relation to the net operating income. Cap rates are people obsess over them because like the most commonly discussed metric when evaluating a property along with IRR when evaluating a deal. And when people are saying, how much did you pay for it? Well, people say, well, what cap rate? Now, cap rates get very confusing because there's a lot of different cap rates, and so it gets fuzzier. If somebody's selling the property at $1.5 million, okay, and their net operating income over the past 12 months, let's go back to the original example, was $65,000. Well, I'm going to undo all my changes. There we go. Then you could say it's a cap rate of 4.33%. Okay, but what's complicated is the net operating income of the seller and the net operating income of the buyer for the exact same asset are not going to be the same. Why would that be? Well, one big difference is that once you purchase the property tax and the insurance are going to go up on the property because you're buying it at likely a much higher price than the previous seller bought it for. So if the property value goes up on appraisal, then the property tax will go up. So even if all of the other operational income and expenses are identical, the net operating income to the buyer is going to be different than the net operating income from the seller. So you have to be careful to look at what cap rate is being quoted. Is it the cap rate based on the seller's information? Or is it the cap rate based on what the buyer would be projected to have over the first year, assuming all of the income and expenses don't change? Okay. So that's one variant of cap rates. Then there is, while you're holding on to the asset, you have an ongoing net operating income that you look at. For example, over whatever the previous 12 months is, you're looking at your financial statements over the past 12 months and you see what your net operating income is. You can also look at market cap rates at that time and see how, are the market value for your property, and you can see what the market cap rate might be, or vice versa. So you can have like your operating cap rate, and you can have your cap rate also compared to what you paid for it, and the net operating income that's current on the deal. So if your net operating income has gone up and you divide that by the price you purchased it at, well, you have that cap rate as well. Okay, then when you sell the property, you have your exit cap rate, which would be your net operating income versus divided by what you sell it for. That would be your exit cap rate. So cap rates are a very good metric for understanding that ratio between net operating income and price. Okay, but there are different net operating incomes and there are different prices. Now, a lot of people obsess about cap rate, but it's really not the most important number. Obsessing about cap rates is like obsessing about the yield on a bond. So many people say, oh, I don't invest in bonds. They're only paying like 2%, 3%, 1%. That's the coupon rate. That's the interest rate on the bond, basically like the interest rate on a savings account. Right? That's the amount of money that you're getting as a distribution back to you for the privilege of having given them your money to utilize. Bonds make people tons of money, even though the rates may be 2%, 3%. Because what happens if the interest rate on a bond goes from 3% down to 2%? Okay, so like a 10-year treasury might be, let's pretend it's at 3%. It's not, but let's pretend it is. And then a year from now, that same treasury bond that you have, well, the new 10-year treasuries are being sold for 2%. Well, that means that people are willing to take a lower return on your money, or on their money they invest. So the value of your bond has actually gone up through the roof. That's appreciation. That's like when the market cap rates go down. Okay, there's a lot of parallels between bonds and real estate because a lot of it is associated with these percentages that are correlated with a price, okay, and correlated with distributions. So if you were to buy a property in cash, that net operating income is your cap rate. Okay, so if you buy a $1.5 million property and you have a 4.33% cap rate, you simply multiply 4.33% times the purchase price of $1.5 million. Your net operating income would be $65,000. Basically, you buy $1.5 million in cash, you can expect to get $65,000 given to you every year in cash flow because there's no mortgage if you bought it with cash. Cap rates only focus on that cash flow. It's like focusing on the bond yield. Now, two different properties could have drastically different cap rates. And people would say, well, I like the higher cap rate. Well, that makes sense. You want to make more money. So you could have a property in Cleveland, Ohio, and it could have an 8% cap rate. And then you could buy a property in Dallas for a 4.5% cap rate. So let's say each of these two properties were $1 million. The one in Cleveland would pay you $80,000 of cash flow per year from net operating income, and the one in Dallas would give you $45,000. Obviously, $80,000 is more than $45,000. Okay, so is that one a better purchase? I don't know. There's a lot more information. Okay, if you're just buying for yield, for the cash flow, then sure, it sounds like the 8% would be better, but not necessarily either, because when you look at those cap rates, those are market driven, right? If two things had the exact same risk or risk reward, they would be priced the same. But people are not going to spend more money for a riskier asset if they're not going to get paid for it. Okay, so basically that percentage is kind of like, again, a bond yield. The higher the percentage, the higher risk of an investment it might be. Like if you're buying a 10% cap rate property, well, how come people are not buying it? Why would the price be so cheap, right? Remember, this is a relatively efficient marketplace when you're buying big multifamily assets. There's a lot of institutional buyers and a lot of just buyers with a lot of money. If something is selling at a 10% rate and another's at 4%, well, there's a reason why that 10% one is being sold so cheap, right? If you buy like a new property that's like a 2015 build and you buy a 1960 property that's 60 years old, they're not likely going to have the same cap rates. Okay, so that cap rate, market driven, is baked into the risk of the asset itself, right? It's like, again, in bonds. You could buy a bond or invest in a bond that pays out a 10% dividend or 10% coupon or yield, not really dividend. That 10% yield, you could say, I'm going to invest $10,000 of this company, and every year they're going to give me $1,000 back. If there's a company paying out 10% for that bond, you got to wonder why they're paying anybody 10%. They're paying 10% because people won't invest money at 9%. Okay, because they are not a very safe company. They could likely go under at any point. That's a very high yield bond at 10%. I mean, a US Treasury bond is the one thing that's considered risk-free, and that's like 1% or less, depending on what year maturity you're getting, how long this bond is. So if you're getting a super high yield bond, you're taking on a lot of risk. You're taking equity risk. You're taking risk the company could fold. There's not necessarily a lot of upside, but there's a ton of downside when you're buying a bond at 10%, because you could lose all of your money, but the upside is just 10%. Now, it is possible the value of that bond could go higher, but how much higher is it going to go? Well, depends on the market. Okay, so all that being said, you should not obsess about cap rates, because cap rates are just the coupon rate of the cash flow, assuming you're only buying an asset for the purpose of cash flow. But you are likely trying to also increase its value, at least to some degree, by decreasing expenses and or increasing rental income. By doing either or both of those, you are increasing the net operating income. Okay, so that value add is not part of a cap rate calculation. Cap rates don't take into consideration growth. Okay, it does not take into consideration changes in the market. If you could get a 4% property, cap rate property, and if you knew that over 5 years it would go down to 3.5%, that's a lot of potential growth in comparison to, let's say, if you bought a property at an 8 cap, but knowing that it would go down up to an 8.5 cap 5 years later, then you're really struggling to fight against market forces when you're trying to drive up the value just to keep it from losing money because of the market. Because again, you can't control cap rates, which is why it's so important to be buying in the right location, because even if you just hold on to an asset and don't make it any better, if you're in the right location, you can still make a ton of money. Okay. Cap rates also don't take into consideration the debt you have on the property, because debt is below the line, which is below the net operating income when you do the cash flow calculation. Okay, so when loans are crazy cheap, like 3%, then getting a 4.5 cap rate property can be very reasonable. But if you're getting a loan at 5% and the cap rate is 4.5%, now this is actually trouble, because your interest rate on the debt is actually higher than the quote unquote interest rate of the property, the yield or the cap rate. That can actually be not just leverage, it's actually considered like negative leverage. Yesterday, when we talked about cash on cash returns and leverage, I showed examples where by taking out more and more debt, you are able to increase your cash on cash return. That's because the cap rates were high in comparison to the interest rates. But if you have high interest rates relative to the cap rate, it doesn't even have to be higher, it can just become pretty close. You actually can decrease your cash on cash return the more debt you put on it, because the interest rate is so high and it eats up so much more of the money. It's very important to look at that when deciding, because if you can be less leveraged and have a higher return, that would be the best of both worlds. But you might not be able to get the asset because you might not have enough capital. All right. So again, refresher, cap rates, market-based. The cap rate is equal to the net operating income divided by the price, or the price is equal to the net operating income over the cap rate. Okay. Cap rates go up over time, the value of your assets is going down. When cap rates go down over time, the value of your asset goes up. Okay. When you increase the net operating income, you increase the value of the property. You do not affect the cap rate of the property. Cap rates are market driven when we're talking about commercial properties. Okay. Cap rates are not the be all and end all. Cap rates are just one of the things, like when you're looking at a bond yield, and you can make tons of money in bonds because you can always sell them for huge capital gains, which is what we plan to do with a lot of these properties. Get about half of your return in gains and half of your return in cash flow. Sometimes it's a little bit more one way or the other, but buying just for the cash flow or just for capital gain or growth might not necessarily be the best of all situations. Okay. And just because a cap rate is low, it doesn't mean it's not necessarily a good investment. Those might be the safest investments because people are willing to put their money there, right? Okay. This was not a 5-Minute Friday episode. This was a full shebang. All right. Thank you all for joining. This is, again, for my entertainment, hopefully yours. Not formal, certifiable, professional, financial, accounting, real estate, any other advice whatsoever. I could be wrong about all of this. Please consult with your professionals before making any decisions with your own money. Until tomorrow for episode 123. Have a great night.